Topic introduces the structure of fixed income issuance and trading within global capital markets. Fixed income markets facilitate the transfer of capital from investors seeking stable returns to issuers requiring financing for operations, investments, or public spending. These markets are significantly larger than equity markets in terms of outstanding securities and include a broad range of issuers, maturities, and credit qualities. Bond markets are segmented according to issuer type, maturity profile, currency denomination, geography, and environmental or social features. Understanding the organization of these markets helps analysts evaluate liquidity, pricing efficiency, credit risk, and the investment characteristics of different fixed income instruments. One major segmentation criterion in fixed income markets is issuer type. Governments, corporations, financial institutions, supranational organizations, and special purpose entities all participate as issuers. Sovereign governments issue debt primarily to finance fiscal deficits and public expenditures, while corporations raise funds for expansion, acquisitions, or refinancing existing liabilities. Special purpose entities issue asset-backed securities supported by pools of financial assets. Investors in these markets include pension funds, insurance companies, banks, mutual funds, central banks, hedge funds, and individual investors. Each participant has unique objectives regarding return, liquidity, maturity, and risk exposure. Consequently, market structure reflects the diverse financing needs of issuers and investment requirements of institutional and retail participants. Credit quality is another key dimension used to classify fixed income markets. Credit rating agencies such as Standard & Poor's and Moody's evaluate issuers' ability to meet debt obligations and assign ratings accordingly. Bonds rated BBB- or higher by S&P, or Ba3 or higher by Moody's, are considered investment-grade securities with relatively lower default risk. Bonds below these thresholds are classified as high-yield or speculative bonds and typically offer higher yields to compensate investors for elevated credit risk. Changes in credit ratings can significantly influence market prices, investor demand, and borrowing costs. Analysts therefore rely heavily on credit ratings when assessing the relative risk and attractiveness of fixed income investments. Fixed income markets are also categorized by original maturity. Money market securities have maturities of less than 1 year and are generally used for short-term financing and liquidity management. Examples include treasury bills, commercial paper, and repurchase agreements. Intermediate-term bonds typically mature between 1 and 10 years, while long-term bonds extend beyond 10 years. Longer maturities generally involve greater interest rate risk and uncertainty, leading investors to demand higher yields. Issuers choose maturities based on funding objectives, refinancing considerations, and prevailing market conditions. Maturity segmentation allows investors to align fixed income investments with liquidity needs, risk tolerance, and anticipated changes in interest rates and economic conditions. The issuance process for fixed income securities occurs primarily in the primary market, where issuers sell newly created bonds to investors. Investment banks often act as underwriters by structuring offerings, determining pricing, and distributing securities to institutional and retail buyers. Governments frequently issue securities through auctions, while corporations may use negotiated offerings or private placements. Primary issuance allows issuers to raise new capital directly from investors. The terms of issuance include coupon rate, maturity, security provisions, and covenants. Successful issuance depends on market demand, issuer creditworthiness, prevailing interest rates, and economic expectations. Efficient primary markets are essential because they provide organizations and governments with reliable long-term financing sources. After issuance, bonds trade in the secondary market, where existing securities are bought and sold among investors. Unlike equity markets, which are often exchange-based and centralized, fixed income markets are largely over-the-counter markets involving dealers and institutional participants. Dealers maintain inventories of securities and facilitate transactions by quoting bid and ask prices. Secondary market liquidity varies considerably depending on issuer type, maturity, issue size, and credit quality. Government securities usually trade with high liquidity and narrow bid-ask spreads, while corporate and high-yield bonds may trade less frequently. Secondary trading enhances price discovery, market efficiency, and investor flexibility by allowing participants to adjust portfolio positions before maturity. Fixed income indexes play a vital role in performance measurement and portfolio management. These indexes track the returns and characteristics of specified segments of the bond market, such as government bonds, corporate bonds, or global fixed income securities. Indexes are constructed based on criteria including issuer type, maturity range, currency, and credit quality. Investment managers use indexes as benchmarks for evaluating portfolio performance and guiding passive investment strategies. However, Bond indexes differ from equity indexes because new bonds are continuously issued while existing bonds mature. Consequently, fixed income indexes require frequent rebalancing and may be influenced by issuance activity, debt levels, and changing market conditions over time. Topic ultimately emphasizes the importance of understanding how fixed income markets support economic activity and investment management. Efficient issuance and trading systems enable governments and corporations to access capital at competitive costs while offering investors a broad range of risk-return opportunities. Market segmentation by issuer, maturity, and credit quality helps participants identify appropriate investments based on objectives and constraints. The interaction between primary issuance, secondary trading, dealer activity, and benchmark indexes creates a dynamic financial ecosystem that influences interest rates, liquidity, and economic growth. A comprehensive understanding of fixed income issuance and trading is therefore essential for analyzing bond markets and constructing diversified investment portfolios.